Welcome. I'm Diana Hoff, and this video is part of Mountain West IRA's continuing education series. Obviously, your self-directed IRA can earn income. Touch it the wrong way, and the IRS can disqualify the entire account, not the investment, the IRA. Understanding cash flow inside a self-directed IRA is one of the most important concepts to grasp if you are considering alternative assets in your retirement account. Today, we're going to break down exactly how cash flow works inside of a self-directed IRA, where that income goes, what you can do with that income, and the rules you must follow to stay compliant with IRS regulations. By the end of this video, you'll have a clear understanding of how to properly manage cash flow inside of your self-directed IRA. So let's start with the most fundamental question. When your self-directed IRA owns assets that generate income, where does that income go? The answer is simple, but critical. All income generated by assets held in your self-directed IRA must flow directly back into the IRA itself, not to you personally, into the IRA. If your IRA owns rental property, rental income goes into the IRA's bank account. If your IRA holds a promissory note, interest payments go into the IRA's bank account. If your IRA owns private stock that pays dividends, those dividends go into the IRA's bank account. This is not optional. This is an IRS requirement that applies to all retirement accounts. The reason for this rule is straightforward. A self-directed IRA is a tax-advantaged retirement account. Traditional IRAs grow tax-deferred. You don't pay taxes on income or gains until you take distributions. Roth IRAs grow tax-free. Qualified distributions in retirement are not taxed. For those tax benefits to work, all income and gains must stay inside the retirement account until distributions are taken. That's according to IRS rules. This is where many people get tripped up. Your self-directed IRA is a separate legal entity for tax purposes. When your IRA owns an asset, that asset belongs to the IRA, not to you personally. You are the beneficiary of the IRA, but you are not the IRA itself. That separation applies to both income and expenses. Here's a practical example. Your self-directed IRA owns a rental property. Tenants are paying rent each month. Who do those tenants pay? They pay your IRA, not you. Rent payments must be made payable to your IRA as the legal owner of the property. You cannot personally collect the rent and then move it into the IRA. That would be considered a prohibited transaction. The same rule applies to expenses. If the property needs repairs, property taxes, insurance, or maintenance, those expenses must be paid directly from the IRA account. You cannot pay them personally and reimburse yourself later. All transactions related to IRA-owned assets must flow through the IRA. So, this is where the flexibility of self-direction really shows up. Once income flows into your self-directed IRA, you control what happens to that cash within IRS guidelines. Cash sitting inside your IRA gives you options. You can hold the cash while waiting for the right opportunity. You can use it to acquire new alternative assets. You can diversify into different asset types. You can use it to pay expenses for assets your IRA already owns. This is what self-direction actually means. You direct where the capital goes. You're not limited to the investment menu offered by a traditional brokerage firm. Your IRA can use available cash to invest in real estate, promissory notes, private placements, private stock, precious metals, cryptocurrency, oh my gosh, and so much more. As those assets generate income, the cash flows back into the IRA and you decide what happens next. This is often referred to as recycling capital inside your self-directed IRA. Income comes in, stays tax advantaged, and is redeployed according to your strategy. Cash flow versus distributions. This distinction is extremely important. Cash flow and distributions are not the same thing. Cash flow is income generated by assets owned inside the IRA. It flows into the IRA automatically and remains there. Distributions are withdrawals you take from the IRA for personal use. So cash flow stays inside the account. Distributions leave the account. You can't redirect cash flow from IRA assets to yourself personally. Doing so would disqualify the IRA. If you need money personally, you must take a formal distribution and follow IRS rules. Traditional IRA distributions are generally taxed as ordinary income. Distributions taken before age 59 and a half may also be subject to a 10% early withdrawal penalty. Roth IRAs follow different rules. Contributions can generally be withdrawn at any time. Earnings distributions must meet IRS requirements to be tax-free. The key takeaway is this: managing cash flow inside your IRA is not the same as taking money out for personal use. While the rules are consistent, the way cash flow shows up depends on the asset. Real estate may generate monthly rental income. Tenants pay directly to the IRA, and don't forget, the IRA pays all related expenses. Promissory notes generate interest payments based on the terms of the note. Borrowers pay the IRA directly. Private placements. They may generate periodic distributions or none at all until a future exit event. It depends on the private placement. Private stock may pay dividends depending on the company. Any dividends go directly to the IRA. Precious metals, those generally don't generate income. They're often held for potential appreciation. Cryptocurrency may generate income through interest programs, depending on structure. Any income flows into the IRA. Each asset has different cash flow characteristics. Some provide regular income, others focus on long-term growth. Some may do both. Understanding these differences is critical when building a self-directed IRA portfolio. So here are a few practical considerations to keep in mind. First, maintain adequate cash reserves inside your IRA. Liquidity matters. Cash allows you to handle expenses and take advantage of opportunities. Second, understand the income profile of an asset before your IRA acquires it. Know whether it generates cash flow, requires ongoing expenses, or is primarily growth focused. Third, plan ahead. If your IRA owns real estate, know when taxes and insurance are due. If you own notes, know maturity dates and payment schedules. Fourth, be aware of required minimum distributions. If you own a traditional IRA, a pre-tax IRA, or 401k, RMDs generally begin at 73 or age 75 for certain individuals, totally based on your birth year. If your IRA holds illiquid assets, planning for distributions becomes especially important. Roth IRAs don't have required minimum distributions during the owner's lifetime, which can offer more flexibility. There are a few common mistakes to watch out for. Personally collecting income from IRA-owned assets. Paying IRA expenses from personal funds, or trying to loan money to your IRA. Don't confuse cash flow with distributions. And of course, failing to plan for liquidity needs. Each of these can create compliance issues if not handled properly. Understanding and respecting the separation between you and your IRA helps prevent these problems. Let's talk briefly about the role of your self-directed IRA administrator. Mountain West IRA serves as a neutral third-party administrator. We handle record keeping, process transactions, and ensure documentation aligns with IRS requirements. When income flows into your IRA, it's recorded. When you direct us to pay expenses or acquire assets, we execute those instructions. What we don't do is provide investment advice or make decisions for you. Self-directed means you direct the strategy. You're in control. The administrator facilitates and documents those decisions. So, let's recap. All income generated by IRA-owned assets flows back into the IRA and stays there. You cannot personally receive that income without taking a formal distribution. Cash flow and distributions are not the same thing. Different assets have different cash flow characteristics. Liquidity and planning matter. And your administrator facilitates your instructions, but does not make decisions for you. Understanding how cash flow works is essential to successfully managing alternative assets inside a self-directed IRA. As always, you can visit www.mountainwestira.com for any additional education you might need. You have easy access to our blogs and our videos, and you can also call us at 866-377-3311. Or, of course, you can always use the QR code in the corner to schedule a free consultation with us. Mountain West IRA provides education and administrative services. We don't provide tax, legal, or investment advice. Always consult your CPA, tax professional, or financial advisor regarding your specific situation. Thanks for watching. And remember, knowledge is one of the most important and powerful tools you can use to take control of your retirement strategy. See you next time. Bye.